Good morning. I'm Joe Scott. I head up the financial institutions team at KBRA. I'm filling in for Bill Cox, who had a last-minute scheduling change. And welcome everyone to KBRA's first in a series of webinars designed to shed light on the opaque world of private credit. On Monday, we published our quarterly BDC compendium, which we will discuss today, along with insights into third quarter risks and challenges. While our focus is on BDCs today, we're also joined by experts from our funds team and structured credit rating teams. These teams, with our corporate team and our asset manager rating groups, provide KBRA with an expansive view of the $1.2 trillion private credit market. And then our view is shaped by a multitude of ratings. We rate 20 BDCs, an additional 123 ratings secured by private credit funds, over 70 middle market CLOs and other structured credit vehicles, as well as ratings on 37 asset managers, many of which have extensive private credit practices. We also perform ratings on underlying corporations, middle market companies, and then many credit estimates totaling into the thousands. And then also earlier this week, our sister company, KBRA Analytics, announced the acquisition of Direct Lending Deals, or DLD. And that's a news platform that provides investors and originators with real-time news and analysis on terms in direct lending. DLD is a unique player in the space with a focus on private equity-driven financing. In assigning our ratings, we take a collaborative approach. Our sector teams collaborate to form an understanding of the risks in private credit portfolios, including, more recently, the effects of macroeconomic headwinds. These headwinds include naturally rapidly rising interest rates, falling valuations, inflation, supply chain pressures, and the slowing economy. While modestly rising rates and steady increases in rates are good for the cash flow of many of these credit funding vehicles, the tables turn if rates rise too rapidly, and the effects of headwinds cause rising defaults and restructurings of underlying credits. So we'll discuss this and more today, as well as in future webinars. But first, let me welcome the team, my colleagues here. Terry Seelig is a senior director at KBRA with a primary focus on BDCs and asset managers. She has over 15 years experience covering non-bank financial sectors. Prior to joining KBRA, Terry worked at Goldman Sachs, Fitch Ratings, and Bankers Trust Company. Now we have Gopal Narasimhamurthy. He's a managing director and leads the North American funds team. He's been with KBRA since 2014, covering a number of sectors, including ABS, public and project finance in New York, also in Europe out of our Dublin office. Before KBRA, Gopal was at Moody's Investors Service. And then we have Sean Malone, a managing director in our structured credit group at KBRA, where he focuses on CLOs, CDOs, warehousing, financing transactions, and related research. Prior to joining KBRA, Sean worked for 5 years at S&P. Prior to S&P, he spent 5 years at Barclays. I'm going to kick off with a question for Terry. Terry, let's start with a topic we know is top of mind for BDC investors. What are your views on liquidity for the sector as we enter this uncertain and volatile market environment?
Thanks, Joe. Liquidity is, as you know, a critical metric when we're looking at BDCs. And given the current market environment with so much uncertainty, we really wanted to hone down and look at our universe of BDCs to see where they stood. You know, what type of refinancing risk was there in short-term maturities? Actually, what we found was there were very little near-term maturities. For our universe of BDCs, we're looking at only $1.6 billion over the next 2 years. This is really due to a lot of issuances of unsecured debt in 2020 and 2021. The BDCs took advantage of the low interest rates and access to the capital markets. So there was a real abundance of unsecured debt issued over the last couple of years. So that really has extended maturities and limited near-term refinancing risk, Joe.
Thanks, Terry. And then when you add unfunded commitments, what does coverage of near-term maturities and the unfunded commitments look like?
Yeah, sure. So the coverage is solid. You know, we looked at SPV asset facilities and committed revolving bank credit lines and cash. And we compared that to the near-term maturities, which there weren't very many. So most BDCs were able to cover that quite comfortably over 2 times. So then we said, let's look at the unfunded commitments. And the unfunded commitments, we had a median of about 1.4 times, which is adequate. But when you look at the unfunded, a majority of that, or a large portion of that, is really delayed draw. And delayed draw lines are only drawn under specific conditions once they're met, whether they're performance metrics or an M&A transaction. So we believe a lot of these lines won't be drawn, which would only further increase the coverage. So there's really solid BDC coverage of both unfunded and short-term maturities. And for those BDCs that have excess liquidity, which there are a number, will be able to comfortably take advantage of opportunities as they present in this marketplace.
And then BDCs, as you mentioned, added a lot of unsecured debt in 2021, the first half of 2022, with about $8 billion in debt issued for KBRA's universe. And then maybe just go into why unsecured debt is so important to a BDC's funding mix.
Sure. We do like, as a rating agency, to see a good amount of unsecured funding. Really comes into play, you know, for what we're looking for is financial flexibility and also unencumbered assets for the unsecured note holders. So from a financial flexibility standpoint, we did see in the height of the pandemic in March of 2020, some of the BDCs having increased margin calls with the collateral being devalued, with credit spreads widening as much as 1,000 basis points. So that put some strain on the operation. So in those circumstances, some of the BDCs had to either sell assets or go to an affiliate of theirs to look for unsecured borrowing facility, which they did, you know, accommodate. And then on the other side, why we like to look at unsecured funding is really because it unencumbers assets, and that's really for the benefit of the note holders, of the unsecured note holders. So that is a critical metric that we do look at, and especially entering this uncertain environment where, you know, the market's very uncertain and volatile. Having the requirement of collateral does add some stress to the operation.
And then another question's on main observations for the second quarter and as we go into the back half of the year.
Sure, thanks, Joe. So worth noting, one is portfolio growth was muted. We did see that as our universe of BDCs, a lot of them are at their leverage at a conservative level, but it was, you know, within their target of 0.9 to 1.25. So because they want to keep the leverage, you know, in check and at a conservative level, portfolio growth has been muted, and most of the volume was really due to replenishing repayments and runoff. You know, the SBCAA has allowed greater leverage, reducing the asset coverage ratio to 150% from 200%. But the BDCs in that light have maintained conservative leverage, which we like to see. And our median leverage of our universe of BDCs are only at one times. So we feel good about that leverage. But as far as private, direct lending and the volume out there, it's still strong. So what we saw, especially with the banks pulling back and the BSL market slowing down, what we saw is a plethora of newly created BDCs to capture the volume and the demand that's out there in private credit. And some of these are affiliates of our BDCs. So what that has done is it's actually opened up because they have SEC co-investment relief. So then they're taking down bigger positions, replacing some of the bank, and they're able to then allocate amongst all their BDC and private credit platforms large holds.
And then what do you see generally the greatest impact of the rising interest rate environment for BDCs?
Yeah, sure, Joe. So, all the talk and the rates are rising, but in effect, it's actually very positive for the BDC universe from an earnings standpoint, especially for net interest income, because what we saw was, so it's very asset sensitive. BDC balance sheets, the loans are being repriced or reset because they're variable rate. And so once they've gone through the floors, which we saw at the end of the second quarter, all the increase in interest rates is being passed on to the portfolio companies and will drop to the bottom line of the BDCs. And we'll see that more materially in the third quarter, especially after the next interest rate increase. So from an earnings perspective, we see it as very positive, and some of the BDCs have already increased their dividends or declared. But from a portfolio company standpoint, as Joe had mentioned in the introduction, we are looking from what kind of stressor increased interest rates will have on the earnings or EBITDA of portfolio companies. So that's one of the variables, other being, inflation, commodities, supply chain, some of the things that Joe looked at. So we are looking at that. We are in discussions with the BDCs. How does the credit quality, and are you stressing your portfolios to see what the impact is? We think, within a range, because interest coverage was high coming into this potential recession, and non-accruals are extremely low from years and years of benign credit environment, that we don't see it as an issue right now. But we are aware that, over the next 6 to 18 months with a potential recession, that there is going to be some uptick in non-accruals. But, that said, we do think our universe of BDCs will be able to withstand, non-accruals and some credit losses. They have their capacity within a range.
Yeah, and then with the private credit funds, go Paul, let me turn to you. How have the private credit fund managers adapted their underwriting standards to account for the current climate?
Sure. Thanks, Joe. So we've heard a number of broad themes from marketplace participants on this point. First and foremost, lenders are moving away from covenant-light structures and focus more on building stronger lender protections into their agreements in anticipation of some market dislocation. Pricing's also, to a degree, reflected this, as we've seen a widening of spreads on top of what is already a rising rate environment. I think this is largely reflective of the risk-adjusted premium and changes to relative value of middle market lending in the current climate. Leverage is also reflecting this as well. The turns of leverage that we're seeing, particularly senior secured lending, tend to be down a little bit, again, in anticipation of some potential distress or deterioration in valuation being one of the more obvious points. And then there's less activity on sector-focused credit, in particular technology from a sourcing standpoint, with more of a portfolio focus on diverse non-cyclical industries. Qualitatively, we've also seen private credit managers are focusing more on the fundamentals of businesses, avoiding certain industries that are more sensitive, say, to supply chain disruption or energy pricing that's been experienced recently. And there's clearly then more of a focus just on stability and certainty of positive net cash flow generation. Valuations in particular, while they've remained stable and are obviously lagging public markets in terms of declines, there have been some declines in valuation that have been experienced, and certainly more to be anticipated in the future. So private credit sponsors are generally still concerned to a greater degree about sponsor alignment if there were to be more mark-to-market declines. At the end of the day, sponsor alignment is still a meaningful differentiating factor in middle market lending, and it's still an important qualitative consideration as part of the underwriting process. But again, given what we've seen in terms of spread widening and decreases in relative leverage, that perhaps is being taken into account to a lesser degree at the moment.
Yeah, then Sean, we'll turn to you now. I know you have some things to share on this topic as well, but first, tell us where CLO structured credit fit into the typical private credit platform, and then also what type of transactions have you seen in the space? We can't hear you, Sean.
How about now? Is that better?
Yeah, that's great.
Okay. So yeah, I share a lot of the sentiments as my colleagues, right? Private credit CLOs and structured credit vehicles, they're a subset of a diverse direct lending platform, and they do originate similar types of corporate credits as BDCs and funds. Some of the differences, generally there are more rigid investment criteria and collateral limitations, i.e. they can't invest in equity or real estate or structured finance bonds. They are meant to be managed vehicles with anywhere from 2 to 5 years of reinvestment, but our private credit portfolios that we have rated do tend to tilt more sort of to the buy and hold side than their, let's say, broadly syndicated counterparts. So this means in times of distress and volatility, we tend to see a pickup more so in restructurings and amendments versus, let's say, a BSL portfolio that are more heavily traded. Debt is typically issued out of an SPV and maybe compared to a BDC or fund, where there's more emphasis on the platform of the originator as a determinant of the credit rating. A CLO or a structured credit rating process would focus more just on the box of assets, right? What's the default probability, the recovery, and the overall cash flows that are being generated by the assets that sit within that SPV. Can you go to the next slide? So, within the CLO and structured credit direct lending space, we've got several verticals which, basically comprise different types of financing structures, including sequential pay or multi-tranche CLOs and, delayed draw warehouses that eventually become CLOs. We've seen single and dual tranche credit facilities, and now increasingly securitizations that combine sort of your traditional, middle market loans with loans that are underwritten based on annual recurring revenues. The alternate structures that we've seen, they share common traits with traditional middle market CLOs in that, and probably funds and BDCs, in that, the loans are generally illiquid. They require covenants, they have lower EBITDAs and more conservative leverage. I think the differences between the facilities that we rated really comes down to structure. Some are less tranched out, some have liabilities that may be fully or partially funded when the deal closes, and those are used to sort of add assets to a deal over time as the manager originates them, or to fund unfunded exposures. So, in terms of liquidity, when we look at a typical, structured credit transaction, they tend to have small buckets or small allowances for, unfunded assets, whether they be revolvers or delayed draws. And, should a big portion of those call for liquidity over time, the counterparty that is, depended on to advance those fundings has to be sort of a highly rated institution. So it kind of, improves the overall liquidity profile and it mitigates, I guess, sort of funding risk in the structure. For the rating activity to date, we've done 70 plus 70 transactions for a total of 26 billion in notional. That's over 300 individual securities or tranches. CLOs and the revolving lending facilities account for, about 2/3 of our deal count, with the remaining coming from those, recurring revenue loan securitizations and ramping CLOs.
Yeah, we'll go on to the next question. Sean, how are the structured credit deals performing currently, and what key factors might affect deal performance going forward?
Yeah, so thus far in 2022, we've assigned new ratings to 90 tranches across 24 transactions, and we've also reviewed nearly 100 individual tranches across 28 seasoned deals that have come up for our annual surveillance in 2022. Of the ones that have come up for surveillance, we've affirmed over 2/3 of the tranches we reviewed. We've actually had some upgrades and some withdrawals, accounting for a quarter of the surveillance activity, and those really owing to partial or full pay downs of the liabilities. At the deal level so far in 2022, there's not been any downgrades. Loan credit quality for the underlying portfolios is stable, but there are some pockets of noise where credit quality might be trending downward as corporate valuations have come under pressure. So for the CLO population that we rate, there's a few key barometers we track on the structural and portfolio side that informs all of our reviews. For coverage, right, senior coverage test levels from an over-collateralization perspective, there's healthy cushion with about 12% on average across our deals. For interest coverage, a ton of cushion at the senior level for about 120% for the amount of interest that's being generated from the assets. Other collateral quality tests, such as spread and recovery, also have healthy positive cushion. For deals that do have some allowance for CCC assets and use that to sort of cash divert, those buckets, they did rise during the height of the pandemic, but they've come off their highs. The average level across our book is about 10%, but that's kind of well below the typical threshold for middle market CLOs. As per defaulted assets delinquencies across the CLO book, per the latest trustee reports, it's about 0.5% in terms of defaulted assets held. And for context, since the start of the pandemic, the highest trailing 12-month default rate for the broader leveraged loan universe was just over 4.5% in the fall of 2020. So, nowhere near those levels. I think we do expect an uptick, in the later half of the year, the last quarter of the year, and potentially in the first quarter of 2023. Other facilities that we rate may be governed by borrowing-based mechanics, including those securitizations of recurring revenue loans that I mentioned. For those, the senior note par coverage is hovering around 150%, so sort of well insulated. There haven't been any defaults or delinquencies reported across the dozen or so transactions we've seen. So those transactions, have continued to perform well. They deliver healthy equity distributions, but again, they also may experience some deterioration in credit quality owing to rising costs and generally the challenging borrowing environment. So in that vein, like Terry mentioned, rising interest rates can be beneficial to floating rate structures, but they can put stress on leveraged loan borrowers from a debt serving perspective. So we think, during this period of volatility, it's important to reflect on a lot of the lessons that we learned during the pandemic that, in comparison, revealed itself as a kind of unprecedented strain on the ability to accurately forecast revenue and then liquidity. Now the conversation has shifted more to costs, right? And how fast are costs rising, and how successful have the underlying companies been in passing through their costs to customers, and what could their ultimate liquidity position look like when the volatility abates. So, given all that, I think it's likely we see more amendments and restructurings, probably in certain sectors that might be more prone to inability to pass through costs and weakening margins. So consumer facing, retailers and restaurants, media, and either some pockets, especially healthcare. Ultimately, we're highlighting the importance of interest rate stresses, not only, in our rating process, but from what we've heard, on the collateral manager side, when they do their underwrite, they're stressing, interest rates to basically a 3 times level from what they started at. And for the most part, CLOs and structured credit vehicles are rate matched. They tend to all primarily be floaters, so investors can enjoy some upside in this environment, so long as the underlying loans perform.
Okay, thanks, Sean. And back to you, Terry. With all this market volatility, what are the BDC marks looking like?
Yeah, so the BDCs, for regulatory purposes, need to market their positions every quarter. So it does introduce a lot of volatility, especially now with the market as it is. But we're looking through that. We mostly focus on the NII, but NAV had come down quite a bit in the second quarter, and frankly this year, due to the credit spread widening. So we saw anywhere from 2% NAV declines up to 6. And so, and most of that is just unrealized losses, which the BDCs, if credit quality stands strong, they'll get repaid at par, and then the unrealized losses will go away. So we still stand by the credit quality and try to look through the day-to-day volatility of the portfolio. The portfolios that had steeper declines in NAV had public stocks. Some of the BDCs do have a small percentage of their portfolio in public equities, so it will follow the market. So especially in technology, so those that had technology public stocks, then we saw the NAVs down much more substantially, more toward the 4 to 6% losses. But like I said, some of it or most of it is for credit spread widening, and hopefully if the credit holds up and the quality, the unrealized losses will go back to par.
And then Gopal, it'd be great to hear your perspective from where you sit. How has the current market volatility impacted fundraising ability?
Sure, Joe. Look, I think the common theme that we always hear is volatility creates opportunity, right? And so in large part, fundraising and the momentum of fundraising continues to be strong. That said, on the private equity side, there's been a little bit of a slowdown of capital deployment in anticipation of potential further volatility, which will create more opportunity, right? Private equity sponsors want to be involved in sort of the vintage of the trough. And so private credit fundraising lags private equity fundraising to a degree, but the momentum of that fundraising continues to be strong, given the anticipation of that deployment acceleration that's expected in the latter part of this year and certainly into 2023 looking forward. All that being said, there's still a flight to quality, and this is thematically something that we saw happen post-pandemic as well, where while there is an increase in fundraising, that capital that's being raised is largely going to be raised successfully by managers with strong established track records, right? The ability to raise capital, deploy that capital, and perform successfully through multiple economic cycles. So those top tier managers or those top quartile managers are certainly the ones that are experiencing that strength and stability of fundraising. Relatively newer entrants to the market, perhaps maybe falling behind a little bit more slightly, but in large part, in aggregate, certainly there's been continued momentum there. Within the private credit bucket overall, there's a little bit more of a focus and discussion on non-traditional private credit. So outside of the typical senior secured sponsor-backed direct lending, those include asset classes like ABL, asset-backed lending, opportunistic credit, which can mean several different things, and of course, special situations. I think this behavior is reflective of both the risk-adjusted return of those kind of more bespoke asset classes and then the relative value of those asset classes as well, but it's also kind of thematically in anticipation of some of that market dislocation that's expected to come imminently. And so I think there's expected to be much more opportunity in those spaces. We certainly saw similar behavior, like I said, in the early part of 2020, which is certainly what's expected to come here as well.
And then Sean, as the credit environment has shifted, have you seen any changes in the types of loans entering the structured credit vehicles, or any changes in the structured credit transaction structures themselves to accommodate all this volatility?
Yeah, so maybe, stepping back a bit, we have a slide here, and it's sort of meant to give some context into the type of loans we've seen across our private credit book. Generally compared to the BSL CLOs, private credit portfolios have had more and wider allowances for as Gopal was saying, that he's seen in his book, other than traditional senior secured loans, including unitranche, first lien, last out, second lien, and now recurring revenue loans. So depending on a particular manager's expertise, these loans can be accretive to structures from a yield perspective, but they do come with certain structural and fundamental risks that need to be sort of considered carefully. And if we think about the last sort of decade plus, it's all been about the hunt for yield, with a lot of capital chasing fewer opportunities, sort of driving down all-in yields on structures. But in today's environment, there's plenty of yield, and there's still plenty of dry powder, perhaps more than ever in the private credit space, as institutional investors get more comfortable with the space and the control that comes with having more proactive lender and borrower relationships, protective covenants, and private equity sponsorship, but also potentially higher risk-adjusted returns. So in that vein, there hasn't been a noticeable shift in the types of loans that are going into the vehicles, but I think, as Gopal alluded to, right, there's a heightened focus from investors that they are being adequately compensated for the types of risks that are inherent to these private credit portfolios. And in some cases, that may mean that deal formation and portfolio construction is delayed. But like the pandemic, managers can dig into their tool belt. As some of my colleagues touched upon, right, they may tilt a little bit more defensively, avoiding underweighting cyclicals or other sectors that are now sensitive to supply chains. For the most part, CLOs and structured credit haven't historically had a big allocation to energy, so that hasn't been a notable shift there. I think there certainly hasn't been an increased focus on software investment generally. That's a sector that we've kind of seen prove itself through the pandemic from a credit quality perspective. And there's a lot of opportunities, not only in traditional CLOs and EBITDA-based leverage loans, but also now in the recurring revenue space. So we've seen a big interest in bonds backed by portfolios primarily of technology and software companies that are generating predictable recurring revenues, and we expect that trend to continue. Maybe if you go to the next slide. We thought it might just be kind of interesting to compare some of the transactions that we've looked at in aggregate based on various structural and collateral metrics. To answer your second question on structures shifting, I think these are the types of structures that are meant to withstand a lot of forces in a downturn. There's certainly an interplay between the leverage a structure will take on, the collateral quality of the portfolio, and the excess spread that's being generated. I think it's important to note that we've witnessed for 15 years in the CLO market that these structures will evolve dependent upon the economic environment to either accommodate or take advantage of sort of what's happening in the broader market. So some of the structural changes that we saw during the pandemic, I think, are on the docket today, right? They're shorter reinvestment periods, shorter non-call periods, more subordination to sort of offset wider spreads, and potential credit deterioration, flipping to a static transaction, not having a reinvestment period. These are probably all on the table right now in the current environment. And finally, the market generally tends to gravitate toward top-tier managers in a downturn with proven track records, just to get deals executed efficiently. So there's a lot of different dynamics at play. That's it.
Hey, thanks, Sean. And then back to you, Terry, to bring us home before we get to the Q&A session. Looking ahead with a potential recession looming and a continuation of rising rates, how do you think the BDC sector will navigate these uncertain times?
Sure, Joe. Just, kind of as a summary, the BDCs have been positioning their portfolios defensively from an investment standpoint in technology and healthcare, and that was even pre-pandemic. So we feel pretty good, a lot of defensive, non-cyclical sectors, which should help them get through a recession. Also, we've seen a migration, higher investments, higher in the capital structure, first lien senior secured, which gives them sizable equity cushions during more uncertain times. And as I mentioned before, the leverage, I think BDC leverage at one time is conservative. So you're going into these uncertain times with low leverage, first lien senior secured, defensive, solid liquidity that we looked at, not a lot of near-term maturities. So, from a balance sheet basis, things look good. That said, we do remain cautious of what's to come with portfolio companies and what non-accruals will bring to bear. So we are, in constant discussion. We look at the credit quality, kind of monitoring where non-accruals are going with slower portfolio growth and rising interest costs. So that said, given the position of where they've come into, from a balance sheet standpoint, we believe that the BDC sector is still quite stable, but we're monitoring closely, especially the portfolio companies and where non-accruals might go.
And now let's go to some investor questions. And I think the first question has to do with market performance, but BDC companies have performed worse than many other sectors. And what can you say about that and how you think performance looks going forward?
Right. So from a NAV perspective, what we talked about before was the, their unrealized losses, right, due mostly to credit spread widening. But from a BDC perspective, we're really looking for the credit quality in that the loans will pay at par eventually. So if we take out the noise of the unrealized losses, the performance seems to be strong because they're able to pass along the rising interest rates to increase NII. So from that perspective, as I've mentioned before, we do think that they're in a solid position and that NII is actually going to increase from that.
And then the second question, how will rising borrowing costs impact the amount of leverage the firms use and the impact on BDC returns?
Right. So, earlier on we spoke about there isn't a large level of near-term funding for the BDCs right now. They really took advantage of 2020 and 2021, the lower interest rates, and portfolio growth is muted because they're staying within a conservative leverage level. So, we think that they're in a good spot and expect leverage to remain contained, and that on a risk-adjusted basis, returns will be solid. That said, if funding interest costs rise precipitously, there could be some decline over time, but the asset side of the balance sheet is variable, so they're passing on the floating rate, and they have a good amount of fixed rate debt. So that only increases, net interest margin. So.
And then what are some of the early signs of an unhealthy BDC? When you examine BDCs, what would be some early warning signals, so to speak?
Right. So from the credit quality, we are looking at the portfolio companies and looking at what non-accruals look like. Also, the BDCs have internal risk ratings, and you can find that in their Qs, and it's usually a rating from 1 to 5, with 1 and 2 being the highest, meaning that these portfolio companies are performing above expectations. A 3 is maybe at or slightly below, but the warning signs would be more in the 4 and 5 when those portfolio companies are poorly performing. So from a credit quality of portfolio companies, that's what we'd be looking at. But as we've mentioned before, is obviously liquidity and leverage play a big part in the sound structure of a BDC.
And then what's happening to credit standards regarding the underlying portfolio companies and in the whole underwriting process?
Right. So, we've been in a benign credit environment, but still the BDCs at, our median non-accrual rate of 0.1%, I think that they've done a good job of managing credit risk and have always had high standards, at least our universe of BDCs, right to strict underwriting standards. And usually, you know, of the amount of deals that they look at, it's usually less than 5% that they actually underwrite. So I think in this environment, there definitely is some caution as far as looking at different economic scenarios, and they might be a much more stressed. But I think that all in all, that the underwriting qualities have been solid. And as I mentioned before too, they're going to be underwriting more of defensive sectors, and they've really been doing that for like over 3 years. We don't see any energy, very little, retail, specialty, any of the real cyclical sectors that will be more impacted during a recession.
And it sure sounds like with the retreat of the public markets, the banks being cautious, that risk-based pricing perhaps has improved.
Yeah, that along with covenants. We're hearing that they're able to get more covenants too, because, you know, this is the only place that they have to go to enter the market. So the BDCs are using that to their advantage, especially in certain sectors of the market, that they are able to get the, you know, 1 or 2 covenants.
Yeah, I think BDCs as well as other credit platforms, private lenders, direct lending platforms, and so on really have an advantage at the moment. And then the last question I have here is the, and welcome any thoughts from others as well, but the DLD acquisition that I mentioned earlier in the intro, and is that a platform that's subscription based, and how can users access it? And I'll answer this question. Viewers can view the platform by going to dldeals.com, dldeals.com, and request a trial. And you get trial access to the news stories and the online database. So that's the first step in accessing DLD. And any other thoughts or questions? Okay, I'd like to thank everyone today for attending, and then also thank my colleagues for some great insights. And if anyone in the investor group, the listeners, have any additional questions, please don't hesitate to reach out to the analysts. And thanks everyone for your time today.
Thank you.